Hello, this is Jed Brewer with Study Groups and the Below the Line Club. We're really excited to have you on the webinar today as we talk about mergers and acquisitions and also provide a brief legal update. I know there's a lot of dynamics that are taking place in the industry, continued consolidation. Also, interest rates are on the rise, and I'm sure several people have questions about what that may mean for consolidation in our industry. A lot of pressure on alternative energy too. So really happy to have two experts with us to speak into some of these issues. The first person who's going to be talking is Spencer Cavalier, who's the co-head of downstream energy and convenience retail at Matrix Capital Markets Group out of the East Coast. But Matrix works nationally to do M&A work and business valuation work when people want to exit, or even on the buy side, or do refinancing work too. And so Spencer's going to talk a little bit about what he's seeing out there in the industry in terms of multiples and transactions and values. And then second, follow-up to that is going to be Jim Dierking, who's an attorney at Winthrop and Weinstine, who's out of Minneapolis, Minnesota. And Winthrop works with a number of companies across the U.S. to help them button up details on deals, but is a full suite legal firm from across the country, so who can speak into a lot of issues. Jim today is going to be focusing on legal considerations when it comes to financing on deals, and then also real estate considerations before and during transactions. So really excited to have these two presenters back. They tend to speak annually about this time and are always one of our best rated and attended speakers for our webinar series. So with that brief introduction, Spencer, I'm going to turn it over to you to give us an update on what's going on with valuations and consolidation activity in our industry.
Okay, thank you, Jed. I appreciate it very much, having the opportunity to participate again this year, and I know Jim does too. I'll provide, like you just said, I'll provide a little bit about M&A activity and the active consolidators, and talk a little bit about financing, and then Jim will talk about legal considerations. So one of the questions we get asked a lot was the activity, strong, the M&A activity that is in 2022. And this is focused primarily on petroleum marketing and convenience retail businesses. So we try to track every transaction we can that hits certain criteria. And so the answer to the question, I'll go over that criteria in a minute, but the answer to the question was, what was the activity in 2022? It was a little bit below average since 2013. We've had about 34 transactions a year. We had 29 that met our criteria, and the reason primarily that we were down a little bit off the average, we think, is that we had so many transactions that occurred in 2021 where people pulled their transactions in 2021, which would have more naturally closed in 2022. And so these are transactions that you have at least 10 convenience stores or 25 supply accounts or at least 2 truck stops. Convenience stores and fuel distribution businesses are the substantial component of the transaction. Sale leasebacks are not included, and private equity type buyers, they're involved, but only through their acquired add-ons to their strategic platform. So looking down at the table below the chart, the graph, you'll see in 2021, all the way to the right, you'll see the enormous activity that we had in the fourth quarter of 2021. We had 31 deals that closed. But if you look at each of the other years, you'll see a more ratable spread by quarter. So that kind of goes to what I was talking about. We had so many deals pulled into 2021. It's important to note, since 2018, there have been 96 unique buyers for the 195 transactions that are included in this count. So far in 2023, I think we're marking towards the average. 7 deals that we know of have been announced and closed, including a couple of ours. So I think we're on pace to having kind of an average year unless something changes. So on the next slide, we get asked a lot about multiples, obviously, and we know we're very careful and confidential about the transactions we do. And so what we do is, as a proxy for multiples, we track the corporate EBITDA trading multiples for there's the 9 publicly traded companies, and then any company that had been publicly traded in the history, we have that factored into this graph that you see on this slide. And so you'll see by quarter since 2013, we're tracking the corporate EBITDA multiples. And so this is enterprise value, so the market value of equity plus the net debt divided by corporate EBITDA by, on a trailing 12-month basis to come up with the multiple. So the average multiple for publicly traded companies, which are listed below in the table, has been since 2013 through 2022 has averaged about 9.8. And today, at the end of the fourth quarter, 2022, the median was about 9.5 times. So again, these are corporate multiples, which are typically higher than store level or asset level multiples because there's more expense contained in the multiple. But the trend line has been, the valuations have been right around the trend line since 2013. On the next slide, we also
One
get
thing
asked.
to ask,
Go ahead, Ed.
I know you get into the specific multiples of deals that you guys do, but just qualitatively, are the private deals that you are doing seem to be similar to what we see here in public multiples, or is there a big difference?
It varies a lot, Jed, by the quality of the assets and where they're located in the U.S. and the channel of trade. So if it's a fee simple, really good, high performing convenience store chain in the Northeast or in California, you definitely could get above these corporate multiples. All right, so you could even get 9 or 10 times store level for those type assets, maybe even better, depending on what their food service and growth platform looks like and how the deal is going to be financed. But in other parts of the country, you're going to be below that in most situations. But again, it comes down to asset quality. For wholesale assets like, dealer decks or other types of fuel distribution businesses, the multiples are typically not as high as they are for retail businesses.
That makes a lot of sense. Thanks, Spencer.
So we get asked a lot, who's driving consolidation? Well, remember that slide a couple of slides ago. A lot of different types of buyers. It's not just the companies on this page here. And this page, you see there's lots of different types of companies, whether they're public, major oil companies, large private U.S. companies backed by private equity groups, master limited partnerships, which are also publicly traded, obviously, and just international companies. But there are a lot of different motivations reflected on slide 6. Some of the ones that have been more active, obviously Circle K and GPM and Casey's on the left under public companies. Obviously, the BP was just announced the deal for Travel Centers of America, and they already own Thornton's. But the other major oil companies have, direct investments via JVs, and Shell has the landmark direct op down in Texas, which they don't operate through a JV. Some of the highlights from the U.S. private companies are Anavi Oil has been pretty active, Majors Management, which everybody knows, and then Petroleum Marketing Group, which is a company out of Virginia, has really been active. From the MLP standpoint, Global and Cross America seem to be more active than Sunoco currently, although I think Sunoco will become more active based on current earnings transcripts. On the private equity side, there's been less activity over the last few months, but they're still active. But some of these are, for example, maybe EG Group, maybe not buying, they may be looking in another direction. But why are these companies attracted? Everybody has a different story. I think BP possibly was, in a short diesel market, and they said they got recommitted to retail and they wanted to get back in. So they took that opportunity with Travel Centers of America. But companies are motivated, are coming off a high margin year. I think rack to retail margins were about 44 cents per gallon on average last year versus 26 cents per gallon in 2021. But there are some concerns. There's been a little bit of volume decline. What I hear usually are 1 to 3% for most chains. And then a lot of concern about direct store operating expenses, which have really gone up at a double-digit rate for the last 3 fiscal years or calendar years. I think they were up about 16% in 2022 based on the preliminary data that NACS has put together.
And Spencer, a question on these major oil companies. When I talk to people with more gray hair than me, they talk about the cycle of majors entering and exiting and entering and exiting over time. And it seems that we're in this cycle of majors getting back into the downstream. And it's unique that they tend to be doing it through JV partnerships. Can you speak into any of that or the why behind the JV as opposed to direct operations in the downstream?
Yeah, I'm not, my thought is that they got out of direct ops, years ago because they just can't run them as efficiently as a retailer can, like a traditional retailer. So the JV partnership gives them the opportunity to do what they do best, which is provide capital and fuel. And then the retailer, the local retailer can focus on running the retail chain more efficient, the most efficient, right? That's why I think they do it. And you may have other ideas, but that's basically what I've seen and heard.
Yeah, let the experts who know how to run the things run it and provide the capital and get that exposure to retail margins, which have been, as we know, phenomenal here the last few years.
It is. It's interesting, but the Cross America and Global, which are really big companies, and they had adopted and fully embraced only the wholesale model years ago. Now they've re-embraced retail as you follow, and they actually do the direct op themselves through a corporation under the MLP. So like I was saying, when we flip to the slide, there are a lot of different business models reflected here. It's kind of interesting, to watch all of them work. The same thing for fuels distribution. A lot of similar names on this slide with ARCO and World Fuel Services being really active. Parkland has kind of slowed down a little bit. I think they'll come back when the time is right. On the private side, we see a lot of activity from Diesel Direct and the Colonial Group. And just as an example, Suncoast just did a deal. But there's a lot of private companies doing acquisitions, and people, even though we hear a lot about concerns about electrification and all those types of things, I mean, a lot of people are bullish on different types of fuels distribution businesses, and short truck being one of them, the exposure to distillates and the margins there. So I think that the fuels distribution side of the business, even though there's pressure all the time, you can do really well if you can run an efficient business and procure fuel properly. I was going to move Jed over to propane. And so we track propane transactions. We do a lot of them. There were 51 transactions that we've tracked last year, 2022. And a lot of deals are smaller because the industry is really comprised of a lot of small companies, and then it's kind of a barbell of big companies, not as many in between. So it's going to continue, I think, to be a lot of consolidation in propane. They have tried hard, as you know, Jed, to make it a green type industry, and then PERC is really trying hard to sell at the low carbon intensity of the business. But I think just the working capital cost for these smaller companies and just the competition with others like bigger regional companies has really been hard for some of these smaller companies over the last few years. So I think that's really boosted activity, especially in 2022. For the public companies, they're doing well. There's really only 5 of them left today, and they had a dip in 2021 on concerns of a bad year, and then they came back up in 2022. The winter started really cold in October, so they got excited, but people were really worried about the cost of the inventories due to the concerns around Pad 1 and exporting over to Europe. But actually, prices surprised everybody, and in the first quarter of prices on Mount Belvieu went down 35%. So margins are really strong. It's just the weather has not been the friend of the industry in most of 2022, and the start of 23 has been not good for space heat, that's for sure. So trading about, the average has been since 2013, corporate level multiple of 10.2 times. We're about 9.3 median right now for this small sample size. On transactions that are meaningful in propane, and I think it gets meaningful when you're over 5, 10, million gallons of propane, especially if it's a lot of residential. You can get a better multiple sometimes than a 9.3, but there's a lot to do with the quality of those gallons if you're going to eclipse that type of multiple. But we've, fortunately have been around a lot of those transactions that have been at a premium. In terms of consolidators, there are the same type setup. A lot of there's some U.S. public companies like Chesapeake Utilities, known, with their unregulated subsidiary, Sharp Energy, that's their propane company. Star Group has been active. Ferrogas has been a little bit active and trying to be more active. Haven't seen a lot of activity on traditional propane from Suburban, but they have done some stuff in the renewable propane area. Under the financial sponsored backed companies, Dead River or Thompson Gas, really, which is owned by Redwood Capital, they have continued to be very acquisitive, as well as Energy Distribution Partners, which is owned by Pritzker Private Capital. So those private or private equity backed companies, along with Superior Plus, which is down on the left side, they have been the most active consolidators in the last 2 years from our perspective. So Jed, I was going to talk a little bit now about financing. So I put a pretty, go ahead, Jed.
Just one question before you turn into financing on valuations. With interest rates increasing, as you look ahead, do you see any modification or change to what multiples may be going forward?
We're getting that question almost, seems like every day. So I'm going to back up. And in terms of the strategic buyers, the public companies or the ones that are not backed by private equity, we haven't seen a diminishment in multiples. I think it's probably because a lot of those companies are still getting real synergies in their acquisitions, and maybe they outweigh the increased cost of capital. Also, there's a lag in the increases in cost of capital for larger companies because they've hedged, right, or locked in, fixed, swapped into lower cost of capital. And we're going to see in a minute, there was a lot of refinancing done last year. So I think that they're still getting the returns, and they still have a lot of accounting incentives to do deals. But over on the lower right-hand side, we have seen a slowdown a little bit by the private equity groups. I think their desire is to do deals, but they're very conscious about capital, and they don't have this long-term view. And so, we just seen them, they're still active and they still want to do deals. We were just unsure if they're going to be as aggressive as their strategics in the rest of this year. So I think I'll have a better answer for you, Jed, in the mid part or, in the fall of this year. But multiples so far have been good.
Thanks, Spencer.
So that's a good segue to slide 12. And this is a busy slide, but it's a slide where I want to just you to focus on the top 3 graphs. And so this is the institutional debt market. So this is where, people that are placing bonds or doing really larger leverage buyout deals. And a lot of the companies in this market would be, have, when I say corporate EBITDA greater than $50 million. So the reason why we look at this first is because it's this segment of the debt capital markets that has the best data because a lot of it's public, and it can show you the trends better than the more opaque, uh, debt markets. Like I think many on this call probably like senior debt and getting debt from a commercial bank, et cetera. So if you look at the top left-hand side, the syndicated loan market, it was very strong in 19 up and through 2021, and then it started to decline. And at the end of the year 4Q 2022, it ticked up a little bit, because if you see the darker blue part of the graph, there was a lot of refinancings being done as people went into 2023 and they wanted to secure certain terms and costs in their debt portfolio. So it's a pretty significant a decrease in the loan market there. And the middle segment shows the busiest borrowers. Now this is kind of showing you, speculative and highly speculative credit rated debt. And you can see in the bar to the right, 4Q 2022, the red and the pink portion of the bar is less. And there are the more risky credit rated bonds and leveraged loans that have been on the market out there. And you can see that they comprise a smaller part of the overall leveraged loan volume. And then all the way to the right, it looks at how private credit is coming into the business and taking even more market share from traditional banks. And so these are companies like Monroe Capital, Churchill, Twin Brook, Stellus Capital. These are private lenders who can be very decisive. They're obviously faster. Oftentimes they have industry expertise, and a lot of private equity and larger consolidators, they use non-bank financing platforms to get deals done quicker because they're just more flexible. So that's the bigger market. And I don't know if there's anybody on the call that would fit into that. But in the middle market, which is issuers with EBITDA less than or equal to 50 million, which we'll just call it the middle market. We get a lot of questions about how much debt can I put on my EBITDA? What is the funded debt to EBITDA multiples out there? So this is a good slide that shows you, a combination of different types of debt, where it be first lien debt, which is blue, or second lien debt, which is kind of orangish. Then there's other types of debt like mezzanine debt in the blue box, and then other forms in the whatever the other color is down below, purple. But you can see in 2011 things started to tick up to get back to like a 4.2 all-in multiple funded debt to EBITDA, and it's kind of flattened out around 5.5 times. So, and again, that includes not only senior debt, but any form of type of debt that you can put on the balance sheet. I do expect that to tighten up a little bit. It'll be interesting to see if you look all the way to the right, we're down to 5.4. I think it will tighten up as the year goes on. And then on the next slide, to give you a little more detail on terms, and this is the reason I wanted to put this slide in here, because it compares February 2023 to February 2022. And it's similar to what the first line is, cash flow to senior debt. And you'll see in February of 2022, the column to the right, we were at 3.25 times to 5. And many in this market believe that you'll be trading at 3 to 4 times funded debt to EBITDA. Then total debt, including junior capital, the next line down, it's come down from February of 2022 about a half a turn all in, which is consistent with the slide before. Pricing on senior debt cash flow, in February of 2022, the spread was about 2.25% to 4%. Today, we're looking at SOFR at 3.75% to 5%. And for non-bank lenders, it's a little bit higher, say 6 to 7.5% versus 4.5 to 6% a year ago this month. The next line down is unitranche and second lien pricing. So this is unitranche is when you have a facility with one lender all the way down the right-hand side of your balance sheet. They do It's all kind of working together. Maybe your revolver, your term loan, everything's priced together, kind of similar to an asset-based loan plus the term debt. So a year ago in February, we were a spread of 5 to 7.5% floating on top of LIBOR. Today, we're at 6 to 8%. And then subordinated debt pricing, this is the cash pay of subordinated debt. It's gone up about 200 basis points from 9 to 11% in February of 22 to 11 to 13% current pay in February of 23. And again, this is a broad, it depends on how much real estate you have. It can be less expensive if you have a lot of really good collateral, but this is just a broad snapshot, Jed.
That's really interesting to see. Previous slide, I think it was about 5.5 funded debt to EBITDA, what people are kind of willing to do in this market and how that's increased over time. And what's interesting when we look at our study group members, just for the data we have, their ratio has improved over time, and it's about 1.5 funded debt to EBITDA for the typical study group member right now, as EBITDA has been really strong. And
that's right.
Earnings.
Yep, everybody. I mean, then you're seeing certain companies do special dividends, and like Global just did a special dividend, right? Because their funded debt to EBITDA had gone down significantly. So it's a good time in the industry from that standpoint. So Jed, that is my last slide. I don't know if there are any more questions.
Yeah, another stat I guess I would throw out just on the strength of study group member balance sheets right now is if we just look at the stock of debt to the stock of equity, like if we go back to 2008 before the financial crisis, people used to have more than $2 of debt for every dollar of equity. And then today it's 50 cents of debt for every dollar of equity. So really strong balance sheets out in the industry right now as we think about what the future may hold in terms of threats if margins were to deteriorate from where they are. People are really well positioned, at least more traditional family businesses in the industry. And that's, of course, on average, there's always uniqueness to the story. And then, Spencer, I'm just curious, as we look forward, do you see any major changes on the horizon in terms of what banks are willing to do, either financing or changes in the consolidation activity that may be ahead, or is it steady as she goes?
And we're on the phone with a lot of the primary lenders in the industry, and they're eager to put more capital to work. And they, I was speaking with one yesterday. Their credit committees are bullish on the industry. They think, and they're not worried about volume they're always going to worry about electrification a little bit, but just, systematically, they are bullish on the industry. So, but I think in terms of their rates and their covenants and all those things, they're going to have lots of different pressures, and it's going to be a little more, it's going to be a little more challenging to go out and raise a lot of capital. But I think the banks are too, as you say, that our companies are stronger, and our banks, even though they have a lot of liquidity. This is not 2007 and 8 again. We're in a much better position from the solvency of our banks. So we're in good shape.
Oh, it sounds really good. And one question that did come in from the audience, we've been talking a little bit about middle size or large deals in the industry. What about the real small stuff? So mini market deals. What are multiples for small home heat / propane retailers or 2 to 3 store operators? Any ideas on that?
Again, it depends on where it is and if there's real estate and how strong they are. Let me just give you an example. We had a niche retailer, small chain in the right part of the country, extremely high cash flow, store level. We got well over 9 times store level, but it was a unique situation. But if you were to go into a more rural environment, not as good of condition, not as good cash flow. You could be, for same property, you could be 5.5 to 7.5. It just depends. It's hard to give ranges for heating oil, 4 to 6 maybe on a corporate basis. It just depends on where they are, the quality of the gallon. So it's so hard to answer those questions globally, Jed. I encourage everybody, get a good advisor, not to give myself a shameless plug, but I said a good advisor, and get educated so you have a really good perspective and expectations before you expose your business to the market. And that's how you get your best deal.
Yeah, I hear you on that, Spencer. And also, like, what are the earnings, right, that you're going to do the multiple on really small deals? Owner salaries make a big deal, how their perks, country club memberships, all that kind of.
Well, yeah, we spend a lot of time right there, like, digging through even the general ledger to make sure we have everything we can defend as part of what we can sell. And that's, of course, that's why we have a lot of CPAs on staff, because it's easier like that. But that you really just need to have something that's very defensible and bring integrity into your process. Like when the buyers out there are spending real money to analyze an offer on your company, and yet if you want the best value, do really good work, build integrity into that sell process, and you'll get your better offers, or your most reliable offers, in terms of being able to close the deal, which is what you really want to do.
Sounds really good. Thank you, Spencer, for sharing that information. And for the audience, if you have any other questions for Spencer, feel free to type them in the chat box. We'll turn to Jim now, but we can wrap up at the end with any other questions. And also, we're recording this, and we'll send out both Spencer's and Jim's contact information so you can follow up directly with any individual questions you may have afterwards. So let's turn now to Jim at Winthrop and Weinstine. And Jim, you're going to be talking about legal considerations, both legal issues around financing and also real estate considerations. So I'll turn the floor over to you.
Thanks very much, Jed. I greatly appreciate having the opportunity to speak to the group again this year and to join Spencer in this presentation. As you mentioned, I will be focusing on legal considerations around financing and M&A transactions with a focus on the real estate piece of both of those. As many of the people on the call are undoubtedly aware, many M&A transactions in this industry do involve real estate, which is often one of the key assets being transferred. Not all transactions, obviously, but many do. And as we've seen from Spencer, many of those transactions are also financed in part, often with loans from a bank or a group of banks, depending on the size of the transaction and the nature of it. So, whether you're obtaining financing for the purchase of a portfolio or selling a portfolio, you'll be required to make a number of reps, warranties, and covenants that relate to the real estate and obviously to any other assets that might be involved in the transaction. So the thought here today is that with a little pre-transaction preparation, you can assure yourself a smoother, less chaotic negotiation with your buyers and lenders. I think we're on the next slide now, Spencer. Thank you. So on the financing side, financing transactions in this industry obviously come in many shapes and sizes, from small loans that might focus on a single location to loans secured primarily or partly by fuel supply contracts, to large syndicated loans that might be secured by substantially all of the borrower's assets. And in those transactions, you may or may not include mortgages on multiple locations or negative pledges in lieu of mortgages. We have seen at the higher end, the larger deals with many retail locations, we've seen a number of those transactions utilize a negative pledge approach as opposed to put mortgages on all of the locations, just as a way to reduce time and expense, but that's very much a case-by-case matter. With every financing transaction, there comes a level of due diligence that the lender is going to complete prior to closing. And where the collateral for that deal does include real estate, the due diligence will typically include things like appraisals, title review, surveys, environmental reports, and potentially physical inspection reports. Of course, other types of collateral might include equipment and other personal property or fuel contracts where fuel distribution is meaningful. But our primary focus again today is going to be on real estate. One thing that I won't spend a lot of time on today, but can often be kind of an overlooked but critical part of that due diligence are the surveys. Many times the buyers and sellers want to steer clear of having to do new surveys on all of their locations just from a timing and expense perspective. But those can really reveal, lots of critical information. We've seen signs, for example, that might be located on an easement parcel as opposed to as part of the underlying real estate. Access areas may be in the same situation. I remember one nightmare scenario where a survey was not done up front going into the financing transaction, and when the deal went bad and it was time to foreclose, they ran surveys and found out that some of the pumps serving the site were actually located off the property. The property line was just on the other side of the pumps. So that was obviously a sort of nightmare result there that could have been resolved with by doing surveys up front. So again, I won't spend a lot of time on those, but they can really provide a lot of critical information. The next slide, yeah, thank you. So when on the M&A side, as opposed to financing, many purchase agreements again will require lots of reps, warranties, and covenants that relate to the real estate. Those representations and warranties may involve the physical condition of the property, to the status of title, to its environmental condition, and the business operations on the property. So prospective sellers or borrowers that are anticipating a possible transaction in the foreseeable future are well advised to conduct some level of review of their real estate and other key operational assets in advance of that sale or financing process, in order to best kind of prepare for the issues that are likely to arise in the course of the transaction, and as a result then to resolve the likely purchaser and lender concerns before they come up, or more readily when they do come up. There's no magical time frame, in advance of a transaction that I would say you should start doing some of this kind of self-review, but oftentimes 90 to 180 days in advance of a proposed transaction is probably a good rule of thumb. It depends a lot on the size and scope of what you're financing or selling, but that kind of a window in most cases will give you sufficient time to do the reviews that you want to do without whatever sort of due diligence work you might do in that process becoming stale by the time you get to the actual transaction. You do it too soon, then a lot of that work you do might sort of have to get redone at the time of the transaction. So in many respects, whether we're looking at a sale process or a financing process, buyers and lenders' interests largely align, but they come from slightly different perspectives, so they will likely have a slightly different risk tolerance when you get down to the nitty-gritty of making some of the representations and warranties in the agreements. So we are going to kind of look at this all from the perspective of, number one, what are some of the typical reps, warranties, and covenants that I'm likely going to have to make in a sale or financing transaction, and how can I prepare upfront to be in a position to make those? So so this slide sort of just gives at a high level a lot of what the typical representations and warranties are that you're going to run into. And again, this is not going to be by any means, there's nothing that is standard per se, and it's not going to be an exhaustive list, but we'll try to hit some of the high points and the most common ones. The biggies are often relating to environmental issues, tank issues, and then various title related issues. So first off, a couple of sample reps and warranties that you are likely going to have to make around environmental and tanks would include saying that the real properties and the operations conducted thereon by the seller are in compliance in all material respects with all applicable environmental laws. There's been no release of hazardous materials for which required remedial measures have not been completed, and no properties listed on a circular or RCRA cleanup site or state or federal list. And then as to tanks, you would usually kind of see a schedule that sets forth a correct and complete list of all above and below ground fuel tanks that are located on or under the real properties, and which, except as set forth on that schedule, are in compliance with environmental laws. So a lot of it is just disclosure of what's there and representing and warranting that you are in compliance with laws, or that any remedial actions that may have been undertaken in the past have been completed. So what can we do about that? Essentially, all this really involves is assessing all the properties in your portfolio for current environmental compliance, any tank issues, including the age and expected remaining life of the tanks, and any potential leak history, and then the status of any ongoing remediation work. As part of that, it's always advisable, and most folks are going to be doing this from the beginning of any required remediation work, but in case it's been overlooked, it's good to check for the potential of available state funds that might be there to assist with remediation expenses. It's good to understand also any reporting or monitoring obligations you might have as it relates to any remediation work or previous leaks in particular, and how those might impact the purchaser. I think it's also good to be prepared to take and substantiate a position on indemnification over these issues vis-a-vis the buyer, which could range from, anything that happens on my watch is my problem and anything that happens on your watch is your problem, to an as-is kind of a sale, go all across the board. But it's best in summary to have a plan for addressing any known non-compliance, so that you can be thinking about how to best resolve those and negotiate through those things with the buyer. On the title front, there are some very basic reps and warranties, and then some that get a little more into specific areas. So oftentimes you'll start with, a rep that says the seller owns marketable record title to the real properties, and the purchased assets are held free and clear of any encumbrances other than permitted encumbrances. So a very basic, straightforward, I own this and it's free and clear except for XYZ. Now there can, in some cases, be a lot of negotiation around it, what XYZ is, what those permitted encumbrances are. But in general, they are usually matters that are of record that a seller doesn't object to, or that are otherwise accepted by the seller. In this regard, if you're thinking about what can I do up front to address this and be prepared to make this, it's really probably best to be doing some level of a title search, especially as to properties for which, that you've owned for a long time and you may not have any kind of current title information. The title search work usually ranges from a title commitment to what we call an O&E report, owners and encumbrances reports. I think in most cases, at this level and at this stage, when you're in preparation for a transaction, an O&E report is probably sufficient. It's usually much cheaper. And you may or may not find yourself actually doing the transaction, in which case a commitment is just not going to be worthwhile. But an O&E report will tell you the basics of who is the record owner, which sometimes surprises people. They think it's, Company A, but it's really a trust owned by some of the owners of Company A. Things that they just sort of haven't looked at or thought through for some time. So it'll tell you who owns it, and then what are the encumbrances of record, things like mortgage liens and easements and the like. So a review of those as to your properties can sort of raise upfront any potential concerns that buyers might have down the road, and then you can be dealing with them before you get there. Another title type of rep and warranty is to tell the buyers that there are no written leases, concessions, or other contracts granting to any person the right to use, possess, develop, or occupy any of the real property other than pursuant to assumed contracts. One thing we see here that can become an issue in some deals is things like co-location sort of arrangements with, quick serve restaurants, liquor stores, other similar leases of portions of a space that are fairly common in this industry that we've seen anyway. Those, in most cases, are probably going to be assumed by the buyer, and they'll just kind of step in and take over wherever that contract is. But if that's not going to be part of the deal, if the buyer doesn't want that same arrangement, then you might need to be thinking about negotiating an early termination with that tenant. Another title-related rep and warranty that we see frequently is that there are no outstanding purchase and sale contracts, options, rights of first offer, rights of first refusal to purchase, or rights of repurchase or forfeiture of, or with respect to any of the real property or any portion thereof. So basically, no one else has the right to step in and buy this or an option to do so. This is something that is probably in most cases fine, and you're not going to find yourself having to have any concern about this. But in some cases, it's not super unusual to see a fuel supply contract that might include a right of first refusal. And those, in our experience, are sometimes very well and clearly drafted agreements, and sometimes very vague and not well drafted agreements that can really throw a monkey wrench into a transaction. At worst, you can find yourself having to negotiate a full purchase agreement with a potential buyer, and then provide that to the holder of the right of first refusal, who can then say, fine, I'll take it. And then they do the deal, and your other potential buyer is out of luck and has spent a bunch of money negotiating with you. So that's kind of that worst case scenario, but certainly something to be thinking about and looking at your relevant contracts for. Some of the more specific types of title or real estate related reps and warranties would include that the seller hasn't received any notice or is not otherwise aware of violations of the Americans with Disabilities Act. No claims have been asserted under that act. There is no violation or claims under building codes, zoning codes, those types of things. And this is something you're probably going to be aware of if they are in process. But the ones that can sometimes sneak up on people is, especially if you have a fairly significant portfolio, are potential building code or zoning code violations that may have actually been in existence for some period of time, but have just been overlooked, and the business has been operated fine. And it's not until you're entering into a sale transaction or a financing transaction that it comes to light. The most important aspects of this that we've seen, where there are sometimes violations that people didn't know about, can affect things like accessibility and signage and parking. Those types of things where you may be actually underparked at your location based on the applicable zoning code. So it's just something then that you need to be working through in one way or another, and with a little bit of lead time, you're going to have more success to get to a place that doesn't create a real issue with the buyer. Let's see. I think we're still here, Spencer. Thank you. Some other different types of property-related matters and reps and warranties that can come up are, for example, a rep that the real property is used in accordance with all covenants, conditions, restrictions, easements, and agreements of any kind or nature affecting the real property. So what this can kind of bring into play for some locations is private easements, private development agreements, those types of things where you may have entered into some kind of an agreement relating to or with a neighboring property, for example. Sometimes you'll see shared driveway agreements or development agreements for sites that are on outlots of major shopping centers or similar types of developments. So just to be mindful up front of the potential for that and to look and see whether any of your locations are subject to this type of private agreement. And then the next step is just to confirm that you and the neighboring property owner or whoever else is affected by it are in compliance with it, that there aren't any issues, because those will otherwise likely also come into under scrutiny during the sale process. There can be reps and warranties relating to special assessments, ongoing actions that might lead to a special assessment. Really, this is mostly a disclosure issue. And again, you'd want to most likely focus on anything that would impact access, parking, or visibility, those types of things. You may be making reps and warranties relating to utilities that all, water, sewer, electrical, telephone, internet, gas, other types of utilities are installed at the real property. They're connected, they're operational. This is usually going to come up really only in new construction sites. But there are cases, and this is again where a survey kind of comes into play sometimes, is where your property's access to one or more of these facilities might be by way of an easement over a neighboring property, which can all be well and good, and that doesn't mean it's a problem automatically. But again, it's just a matter of confirming that your property does have the right kind of legal access to all of the utilities. Let's see. Access, I think we talked about that just a little bit. Just a straight up rep that your property has legal and actual physical access. Again, sometimes that can be by way of an easement as opposed to direct access to a public right of way. And if it's by way of an easement, again, we just need to confirm that first of all, the term is sufficient, should be perpetual, but if not, then that's something to look at. And secondly, that there's no compliance issues. Another type of rep and warranty that oftentimes people will be making, and I'll try and wrap this up pretty quickly here so we save some time. A couple of them relating to, claims against the real estate or against the seller that might affect the real estate, that there are none. And then with respect to condemnation, that the seller is not aware of any ongoing condemnation actions affecting any of the property. And again, for the most part, where those become potentially problematic are if they affect access, parking, visibility, traffic flow, those types of things. Small little taking a corner to expand a road or something, usually not a problem. With respect to claims, I would just mention that the only kind of what can I do up front as it relates to potential claims is to be thinking about your position on indemnification over any claims and how that might impact the value of the transaction. You can go to the next slide, Spencer. And I think actually, because we're running a little low on time, I apologize for that. There's not a lot new in the covenant section. There are a lot of these will mirror what you'll see in the reps and warranties sections. I guess maybe the main thing that I would mention here is a cooperation and access covenant. Typically, most purchase agreements will have an agreement whereby the seller agrees to cooperate with the buyer on providing them access to information, access to the sites, and to cooperate with the buyer in doing their examinations. So the only thought here is to plan up front to actively participate in the site assessments and inspections. Consider how those are going to be conducted so as to not unduly create suspicions among employees before you announce the sale. Just think that through. So I will wrap it up here. Spencer, you can go on to the next slide. I think that's just kind of a summary. Yeah, preparation is everything. Obviously, we did not go through an exhaustive list of reps, warranties, and covenants, but hopefully you can see that with some preparation up front and some review of your properties, you might be in a better position when you get to the transaction to be able to make all the required reps and warranties and work through any issues and concerns that buyers and lenders might have.
Well, thank you, Jim.
Me, Jed. Save a little time. Yeah.
That you of some of these reps and warranties. Two remaining questions, one for you, Jim, and then one for Spencer. But you see everything under the sun, Jim. I mean, in terms of things that can arise when a transaction is closing. Of all those either reps and warranties, what's the most common things that tend to stonewall a deal or get things in trouble?
Yeah, that's a good question, and you know, it obviously it does vary quite a bit. I guess the most common, where we end up spending the most amount of time negotiating and trying to fine tune, is in the title stuff and the environmental stuff. You know, partly that's because I think different states handle those issues differently. So what works in one case may not work in another case. What works in one state may not work in another state. But I think those are the main categories of issues that we typically see, not necessarily ruining transactions, because they usually don't quite get to that level, but they involve a lot of times the most work.
That makes sense. Yeah. Thank you. Spencer, one wrap-up question for you. Alternatives, electrification, et cetera, in the industry. I know it's been on people's minds a lot. Really, the last decade, people have been saying, you know, it's coming. What is going to be the impact on this industry? Should I get out now? Question for you, do you yet see alternatives impacting prospective buyers' either willingness to pay or the set of prospective buyers who want to participate in this industry?
No, we haven't seen that threat really hinder buyers, but I will say it's more than just electrification. It's for people that don't have the ability to attract traffic count onto their sites. You know, it's an issue because the internal combustion engine has become so efficient and is getting more efficient. So with hybrids, everything that goes into this, and then you have plus electric vehicles, you know, you have to have something else to attract people to your site. So I think that's a bigger concern. And for people that have maybe a more traditional site that doesn't have multiple profit centers to attract the traffic counts or, you know, customer turns in the door and the ring higher inside the box, I think those folks are more concerned than other types of maybe new age, you know, type marketers or bigger box marketers. But if you know, there's many different business models. You know, there's like, you know, majors, they dealerize or they have commission agents and they're doing well with their business model. You can have a hybrid business model where you do big boxes and, you know, you have commission agents and others and collect a lot of rental income. So, you know, so this is a cool industry because there's a lot of different ways to use that real estate. So, but that's a long-winded answer to the question. So.
All right. Well, thank you so much, Spencer and Jim. Appreciate your insights as well. We're going to make this recording available to you, the audience. Also, we will send out slide decks from these. Jim and Spencer's contact information will be in it. So if you have any questions you want to follow up with them, they're more than happy to talk with you. Thank you for your time. I hope you found this valuable. Take care, everybody. Goodbye.